Purchase property as an investment. And then we're going to talk about a new group that we're starting. It's going to be a branch off from AWIG, where I'm looking at you, Simone, because it's going to be a group of people who want to do real estate investing and maybe want to talk to others about it and maybe do some networking. So we'll talk about that a little bit, and then a panel discussion with our guests. All right. A real estate investment fund. So this is something that you can go to Fidelity and purchase, probably Vanguard. So usually you will get cash flow from dividends. That's usually one of the things people want to, that's one of the reasons they want to get it. It's easily trackable. It's just like another line item in your portfolio, as opposed to a house that you have to go and maintain. It will be sensitive to interest rates. So when interest rates go down, companies and personal people are able to buy more. And so it's more effective when the interest rate's going down. And it looks like interest rates are starting to go down, but when I hear some from Morgan, when we talk about that. So whenever somebody says, oh, get a REIT, I automatically think, what is that? And how do I even go to look for one? So I just did a quick search, and Morningstar had an article that said best REIT buys right now. And I pulled 2 of them out of the list of like 9 to talk about, just to sort of have a general idea of what to look for. So this particular one, Realty Income Core, and that ticker is just a 0. I mean, an O, not a 0. So Morningstar says it's undervalued right now. It's trading at 52 as of like Friday, and Morningstar thinks it should be 76. Morningstar is guessing that its dividend would be 5.83 in the future, which is a pretty good dividend. Its uncertainty rating, Morningstar saying its uncertainty rating is low, meaning it feels pretty confident about these guesses. It's not uncertain about it. And then I was reading more about it. It's in the top 7 of dividend aristocrats. And the dividend aristocrats are stocks that have been raising dividends for the last 25 years. There's about 50 of them. And this one is in the top 7, according to another list on another page that I found. So I was like, that is cool. This one sounds like it'd be really interesting. But of course, you'd have to read the article some more and maybe go and look at the company and decide, does this one seem like it's good for you? But this one looked interesting to me, and so it made it to my list. And then the next one was this one, Kilroy Realty, ticker KRC. Right now it's around 38, and Morningstar thinks it should be at 63, or it could go up as high as 63. And it's guessing its dividend would be 6.22, which is like really cool. But its uncertainty rating is high, meaning this is the Morningstar guesses, but it's not as certain about these guesses as it was the other one. So it's more like, take this one more with a grain of salt. Right now they're getting property in these particular areas. And I saw Austin was one of the ones on the list, and it's like, that is cool. So if you don't want to go invest in actual property in Austin, you can invest in a fund where they're investing in the property for you. If you're looking at REITs, another thing you could look at is like, what kind of property they invest. Are they doing retail property? Are they doing condos? Are they doing single family homes? Are they doing business offices? A lot of them that were on this Morningstar list are doing medical science, where they're either making office buildings for doctors or space for, I think with the baby boomers, there's probably going to be a lot of people in retirement homes. So that would be something else to think about. So I wanted to bring this up because like, this is something you could do now without having to go and figure out what property I want to purchase, how much effort do I want to put in, how much money do I want to put away? Because you could just invest as much as you want, a small amount just to get started. And then you have real estate in your portfolio. So real estate, it's not really gonna follow the stock market. It's kind of got its own, ups and downs. So it's why it's a good hedge against downturns in the stock market. Okay, so do you guys have any questions on REITs? Because this is kind of the last we're gonna talk about them, unless you have something specific. Yeah, Simone?
So I'm currently invested in Fundrise. I don't have the option to choose REITs, but I was planning, and I chose it because it's beginner friendly. Is there another platform that you would recommend?
I like Fidelity a lot, but there's also Charles Schwab. They're very beginner friendly. And Vanguard usually has a lot of stuff. And usually these platforms, you can get stocks and funds from other companies. They don't limit you to like just theirs.
Okay.
And Vanguard, one advantage to it would be it has a lot of low cost funds. So you can easily buy some stuff and not pay a lot and kind of have a portfolio that has a lot of different stuff in it and be a little bit more balanced. Did you have something you wanted to?
The previous, the ticker symbol 0 or O.
Yeah.
Was the uncertainty rating the same?
No.
Oh, it was wrong.
Do you think that the difference in their certainty is because of the markets they're invested in?
It could be the markets, but it also could be how long they've been around. Because they might have a better idea how they perform long term.
I guess too, if they've raised the dividends for the last 25 years, then it seems like a safe bet.
Yeah, if they raise the dividends, they're pretty sure they're either gonna be the same or a little bit above.
Yeah.
I was surprised actually to see their estimate at 5.83, because when I went, I guess the dividends, they don't know what they're gonna be until they're published. But on the other page, when it said it was an aristocrat stock, it had it like 6.2. So those are forward-looking dividends. You could do the research and find out, well, what was the last one that they gave them? I'm sorry to say I did not do that, but that's what I would do if I was seriously thinking about investing in this one. Okay. Go to the next page. Okay. So now, at this meeting, we're kind of going to focus on purchasing property in one way or the other. A lot of us have buy and hold rental property where you purchase it and then you rent it. Simone's doing flips, which you can do by yourself or with a partner. And sometimes I think it's hard to find a good partner because you don't know how they're going to act in that situation. House hacking, where you live in a house or a duplex and rent out either another room or the ADU or the other, if it's a duplex, the other unit. And hopefully they pay your mortgage while you're living there. So those are usually good things to start with if you're trying to do that. You could purchase vacation property. You could purchase land and develop it. You could also get in a syndicate, which is what you were talking about, where you basically it's almost like a REIT. You're joining with a group of people to buy something. So you're just one of the investors. Not quite like a REIT, but the general idea is you're not doing the work. You're sort of helping to fund it. But right now we're going to focus on purchasing property. So here's some pros of doing it, some positive things. You get to diversify your portfolio. You get passive income. There's a growth potential when you sell it. Hopefully the real estate values went up. It's a physical asset that some people like the fact that it's a physical asset. They can actually like lay their hands on it. It's not like stock and where how much you're worth is kind of amorphous. You don't really know. You're like, well, I guess I'm worth this much. You have maybe a little bit clearer idea. And also you can live in it. I was telling my husband, it's like, if we have to, we're selling this house, we're moving into the rental house. So that's one aspect I like. You can get tax deductions on it. So as you're managing it, you can deduct certain things in your taxes. And also if you have a lot of gains, but you have a lot of losses in your rental property, that can help balance things out. And a lot of the rich people, I think that's one of their strategies, to have losses with their rental property. Okay, so in the next page, here's some cons. High initial cost. You have to have the down payment and also the closing fee, lots of other fees to fix up things. You have the property maintenance that you have to do yourself, or you have to find somebody to do it. You either manage the property yourself, meaning you keep track of the checks coming in and the deposit and what you plan on fixing next. And potentially you could have loss of value. It could go down in value as opposed to going up, which is what happened in 2008. There was the big crash. And you have to deal with tenants. Who often will say, "Excuse me." Okay, let's go to the next page. So here's just a few of the costs that you might run into. I say a few, it makes it sound like there's a huge list, but so a down payment for a real estate investor is usually higher than it will be for an individual. So it's around 20 to 25% now. Closing costs, paying taxes on the property, getting insurance on the property. You might have to pay a neighborhood association fee. And then you have maintenance and repairs, routine maintenance, which is things like need to fix the toilet because it's not flushing or it's running, versus like major things you have to do, like replace a roof if there's like a hailstorm. Sounds like you have like good stories about that. So there's cost associated with it. Let's go to the next slide. This is like one of the things you might want to look into if you are doing it. You can deduct your mortgage interest, your taxes, the maintenance cost and the repair cost, and mileage as you go to and fro from your apartment or your land or wherever you're, not your apartment, your condo or your house, wherever you're renting. Let's go to the next one. So depreciation, since basically this, I'm gonna say single family home for now, is your property, and in your business, you get to depreciate as the house ages. So it's sort of like the wear and tear on your property is your cost of doing business. And so you get to depreciate that. There's tables that the IRS has about like how long it takes to depreciate different things. So like a house is like 27.5 years, but a roof might be like 12 years. And then if you get a new roof, you start over again and it's a brand new roof. And then every year you get to say, oh, it has this much wear on it. So I'm deducting another like $200. Yeah. So, yeah, tax deductible. So that's like one of the main things that you have to understand if you're managing your own property and doing your own taxes. If you have an accountant or CPA, they understand this stuff really well. Okay. Okay. So that basically, I know that didn't answer a lot of questions. It's just an overview because the panel is what we really want to focus on. But we're starting, like I said, this new investment group, which right now it'll probably be us meeting in a coffee shop somewhere, having informal conversations about what our current problems are, what we're thinking of doing next. Does anybody know a good plumber? At least that's how I envision it, as a group of people. You don't have to come every month. But it's a new Facebook group and a new meetup group. So Austin Women Investing in Real Estate. So if you search for those, you can find it, and I'll also put it on our Facebook, our AWIG Facebook group. And whenever we have a meeting, I'll put the meeting notice out, or Rachel will. Rachel's the co-organizer for this. We're doing that together. And we think, why don't you tell us when we think we're going to meet?
Yeah, I was thinking like our next meeting would be in April, the first week, hopefully maybe like a Thursday evening at like 6:30, 7 o'clock. Again, we will kind of like see how the turnout is for that and like what works best for people. If it's looking like people are having a hard time getting to it at a certain time, we can make adjustments. But right now we're hoping it'll be just like a very like casual place for people to come and like network, get their questions answered, maybe share resources. And so during the week in the evening is kind of what we're hoping for.
Okay.
Does that help?
Yeah, we'll go to the next page. I have, all of us here and, where we work and work and, what we do. So that way you know who we are. And so we were thinking we would start with Sarah asking some questions and then you guys can come up with questions too. Does that sound okay? So I'm gonna sit down as one of the
Cool.
official panelists. Oh my gosh, I'm so excited about this.
I'm just gonna sit here and let you guys talk.
I'm nervous.
Do you have is it weird that you're not sitting under your?
I am, yeah. Yeah, yeah, I know.
I mean, not weird, but. you know.
Yeah.
Morgan has a question.
Yeah.
I'm like. I know.
Okay. All right, so I think we should start with the crystal ball question for everybody. Maybe this is more Morgan, and anyone who has thoughts here. What do you think about interest rates? Where are interest rates gonna go? And how does the interest rate environment impact mortgage rates?
Yes, definitely. So it's been a hard year and a half for our industry, just know. I mean, if anyone was buying in 2020 and 2021 and have those like pretty 2s and 3s in front of their interest rate, I think that's been like the biggest challenge for people and like the inventory problem right now that people are not willing to leave their homes because they have these amazing interest rates. But they were due in part to obviously COVID and having like a world pandemic. So what people like don't understand out there, not this group, but those rates were artificially lowered to help like offset what was happening in our economy. So in that time, like so much of the government, everything was focusing on just creating like reprieve in the rest of the economy in the world. So rates were artificially lowered. Everybody got into homes at that time, but then what they didn't focus on was what was going to happen afterward. And so the result of that was high inflation, if you guys have heard that term. And so inflation got high right after all the 2021. So then what happened, as people saw, the 2022 flip was pretty severe. That, I mean, rates started the year in the 3s, and then by the end of the year, we were looking at 6s. And so that was like, this is the quickest in 20 years that rates have gone up this fast. So it's been a huge shock. And I think so much of our industry too, like people got scared over that time because the lack of stability was huge for people of just not knowing like where rates were going. And so that really did slow our industry down, in particular buying homes and mortgage interest rates, because they really do set the demand of the housing industry. And so where we are kind of catching up now, because rates were on this increase as we were fighting inflation, because the Fed is more focused on other things and knowing that the housing market killed it the last several years, that they were almost like, okay, y'all are fine kind of thing, you know, over the last several years. And so that's really slowed down in loan apps and everything. Actually, this crazy statistic I saw earlier this year that 61% of loan officers got out of the business this past year. It's literally crazy. I mean, there was a massive overinflation of our industry, realtors. Everybody was like, I want to be a loan officer. I want to be a realtor, you know, so good. But anyway, trajectory of where we're at is that rates obviously went up, and in December, rates touched like a little bit lower. We finally saw like our first decrease, like after they capped out probably at like 8 3/8 for primary homeowners with 780 credit scores. It was just so difficult qualifying people over the last year because I mean, first time home buyers slammed with payment and everything. So finally they dipped to like the low 6s again, but it went too fast. So in January, we've kind of like crept back up to like a low 7 right now for primary homeowners. And when I'm talking about rates right now too, we're talking about primary, and then I'll kind of get into how that deviates into buying an investment home or secondary. But for this right now, I'm just talking about the primary rates. So, yeah, they now are sitting at like low sevens. But we do now have inflation more under control. The Fed is very, very, very assertive of wanting the Fed inflation rate to be around 2%. And we're a little higher than that right now. We're like at 2.8 or something. So we're close, but like we're treading water. So all economists are basically saying that rates are going to start dropping third quarter. And what that first drop is going to look like is what we're suspecting is, like I said, now that for great 780 credit score borrowers, we're looking at like 6.99 to 7.25 right now. We're probably going to have that first leg of drop that's going to drop into like the low sixes. And then they're saying probably by 2025 is when we're going to finally settle out into probably around like the mid to low fives, hopefully. I mean, I just keep saying that people get comfortable in a range for sure, because there's not a crystal ball, like we're saying, of where it's going to actually go, but it kind of keeps shifting into a range of where it's going to settle. Because most people with the affordability index can afford homes in that 5% range. Like right now, where we were at, it's like pushing so many people out of affordability. And then on top of that, we have housing prices, we have property taxes. It's a lot in Texas, but yeah. But anyway, yeah, so that's going to open up like a whole shift of people. And actually there was some, I've gone to so many economic forecasts and stuff over the last couple months, but so I'm going to say, oh yeah, that the 5% is going to be finally the shift. There's all these interviews of like for the 2 to 3% interest rate borrowers that are right now sitting on it, like what's going to be the tolerance that's going to be like, okay, fine, I can leave the house. And that they're saying the mid fives. So I think that's going to turn up a lot of inventory. People are finally going to like have some listings out. Like it's going to happen over the next year or so, because everything's going to follow these interest rates and more people coming back into the market. Long, I guess, yeah.
Who's in the market now? Yeah. Oh, no, go ahead.
Another market, I was gonna ask a question.
Yeah, go ahead.
Yeah.
So I guess what I'm thinking is that if the interest rate goes down, then
Mhm.
it's more people enter the market.
Yep.
The housing prices are gonna go up.
Yes. Yeah. It's probably not going to be that crazy go up, but we're going to see a definite shift in demand. And I keep saying, I mean, I know she has so many like listings, like I work with buyers mostly. So like, I keep just like throwing this in, like, it's a buyer's dream right now. Although it's not like you look at your payment that we're quoting and you're like, I don't know. But I mean, I would say mostly because like you can negotiate right now. And that's kind of a big thing. So the people that are listing their homes have a reason to do so right now, because they're not getting like the top of the market price for them. So you kind of have more, if you're not going to offend them when you're offer,
Yeah.
that you can ask for some closing costs to be covered. You can, we can use kind of our own stuff to help make your payment a little bit lower. We have these temporary buy downs that we can use seller credit, that in the short term, we can make it lower. Because if you just hold out this next year or two and you already buy this house, appreciation is going to pick back up again. We are in this lull right now, but we're going to get back to that like 6%, 3 to 6%, even more than that year over year. So I just think it's a good year right now for buyers to just get in if they can. And if you're comfortable with your payment, really over the next year or two. Because the great thing about interest rates, like you're saying, like cares about interest rates. Love you for that. But I mean, they are fluid and you can refinance. And so like we are selling most likely the 30-year mortgages. So we keep in touch with you. My whole goal in life is to be like your mortgage coach for as long as you buy houses, and you're going to make more money over the next 3 to 5 years. What does that look like for you? Like getting into a shorter term, taking cash out, using money from your house, and you'll have that when your house appreciates. So there's just a lot of things you can do and when rates drop too. So
I have a question about, so we're in the process right now of buying a house.
Yeah.
And one of the things that was offered is like the rate buy now.
Yes.
Which is great.
yes.
But then how does that work? Because I was under the understanding that like the rate buying down would be like towards the 30 years that we have
Yes.
the loan.
Yes.
Is it true that it would be only for a certain period of time? So for example, the rate buying down was only going to be like for 2 or 3 years, and then after that, does it go back to what? To the current rate, or do you
Yeah.
have to refinance? How does that work?
Yeah, that's a great question. So there are two differences right now. So these temporary buy downs that are being talked about in this market over the last 2 years have been around since like the 80s, but no one's used them because rates have been so low. So like in the 80s, when rates were like 11% or something, like it helps so much to use these temporaries because it made obviously your payment more affordable in a short period of time. And so much of what I'm doing right now in advising, like I feel like it's changed so much over month with as rates are changing of how I'm advising people. But I would say right now, so discount points, have you heard that term? Okay, so discount points is the term that we use to buy down the rate over 30 years. Yes, so I don't think that's important to do right now because so like a discount point buy down. If a rate right now is 7.25, like let's call your loan amount 400,000 because discount points, the term of that is based off of your loan amount. So if you have a $400,000 loan, 1 point is $4,000. So usually to pay down the rate 0.125, it's around generally half a point, which would be like $2,000. And on your payment, that correlates to like $20 to $30. So it's not a bang for your buck right now because we know that you're going to refinance. So that's why these temporary buy downs have become so much more prevalent in our marketplace because we can use the seller credit, like I was talking about in like the negotiations, you can use that to apply towards a temporary buy down. So like the difference between paying it by an eighth, which would get your payment down $30 and money that you're throwing away. If you do a temporary buy down, you can do a 1-year buy down, which that's what I'm advising right now, because I don't think you need anything longer than a year before you refinance again. If you do that, it's so much cheaper. You probably use like on a $400,000 loan, it'd probably be like less than $3,000. It's a dollar for dollar savings that you can apply towards a 1-year buy down. So if the rate today was 7.25, it's a 1% reduction for 1 year. So the rate would be 6.25. Now you don't get that 6.25 tax interest, like the rate is based off of 7.25. There's no arms, nothing like that. It's just to literally make your payment better. It's been created to overcome the payment shock over the last 2 years. So that reduction would make your payment about $250 to $300 lower. So that is you're like, okay, that makes sense for $3,000, not $30, to reduce. And sometimes there is a case for the discount points, but I would just say not now. Like if you can make it work out in your mind, like if you were paying like 2 points, but you were planning to stay in your house for like 7 years or not change your mortgage, like if that payment ROI made sense, sure, pay discount points. Because sometimes our accountants, it is tax deductible to pay discount points. You have to be in a certain income bracket too. So does that make sense? I know it's a lot. It's a lot. Yeah, I know.
Thank you.
Yeah, no problem. And yeah,
Other rates questions? I have one more rate question.
yeah,
So should we wait for rates to get lower?
to buy. No, like that's what I'm saying. Like the happy place for a buyer is now. Oh, so also cool thing that a lot of lenders are doing, we're doing in particular, because we know that you are purchasing a home now and it would make sense for you to refinance like in a very short term, like within a year, even 6 months, that's the minimum to refinance. We are doing no lender fees. So like usually when you buy a purchase, you have to pay lender fees, the title fees, all the things, and you still have to pay majority of that when you refinance. But lenders are waiving their lender fees. Ours are $14.25, so that's a lot. So we're not having that included in the refinance. And so it gives you a little bit more notion to do it, because at least get in the house, get the appreciation, because what we were talking about, when more buyers flood the market, that gives the end of the demand to the listing agents, and so they can price it higher because there's more people bidding on the house. So right now you don't have as much competition. Doesn't mean there's not any, if there's a cute house, people are still gonna all want it.
I think to like add to that a little
Yeah.
bit too, is like, when you're asking if people should wait to buy, we go over the numbers, with a loan officer, and if like right now people feel comfortable like in that monthly
Yes.
payment, and they're like, you know what, we know that this is gonna be
Yeah.
temporary because we will be able to refinance into a more comfortable payment.
Yes,
Right now, I'm telling my buyers, I'm like, okay, if you can qualify and we can find the house that meets like 80% of your needs with like lower inventory and you feel good about this, then there's more buyer power than we've seen in a long time.
Yes.
So negotiating the seller to pay these closing costs for like a rate buy down, more money off the purchase price, get your closing costs covered. Like some of my clients right now, they're like, okay, well, I have a good down payment. And one thing I feel like your average buyer isn't super sometimes aware of is like, okay, there's more fees than just your down payment. You know, you have your closing costs and things like that. Lately, we've been able to negotiate those so that my client is really only bringing their down payment and their closing costs are waived, which is money that they can keep liquid in case
Mhm.
there are repairs needed to be made, or like we're in a slightly more unpredictable time. So it gives them a little bit of cushion without putting everything into the house. So I think
Yeah,
right now we have that power. If rates do go down, then we're gonna see more affordability, more buyers in the market. Those opportunities to negotiate will then go away.
yeah, definitely not as much. And I keep saying that too, as a tactic. That's good you brought that up. So I was gonna mention just average how much closing costs are and stuff.
That's gonna be the next question.
Yeah, perfect. Okay, well, I'll dive into that. Cause I mean, you guys all sound like you're experienced and have bought a house before, but that is always like a common, like as a first time home buyer, they have no idea how much fees are. They're like thinking about saving up for their down payment, but to know that they're also those closing costs. That's like a huge component that I'm advising clients right now, because that really has not been a thing where you can say, can you cover all my closing costs? A lot of people have been more notion to like ask for the sales price to be reduced, which is fine, but they've already, all these listing agents and sellers have already brought down their prices quite a bit. Like we did have a big adjustment. And so I don't think asking for the sales price to come down a lot more is that much of a cost benefit to you guys. Cause also, and knowing like the difference of like, if you ask for $10,000 off the sales price and not ask for closing costs of like 10,000, and it's the same bottom line for these people, but because, you know, but a $10,000 reduction on your sales price is gonna be about $60 on your payment of a difference. But think about if you're putting $10,000 towards your closing costs, that's $10,000 that you're not bringing out of pocket, and that's huge. So I would always kind of advise that to make sure that's covered first, if you get seller credit, before you even start looking at the rate buy down. Because that's just money in your pocket that has not been historically given in many, many years. Like you would have been laughed in 2020 if you asked the seller to pay, because you know, like people are offering 50 to 100 grand over, like there are no closing costs being paid at all.
And then I
And-
guess, kind of a question then
Yeah.
for you, for like, so for people who are investing, how much should they plan to bring like in closing costs? Do closing costs change for investors then, or do they stay the same?
Great question. Okay, sorry, I didn't even actually mention that. So closing costs in general in Texas are all the same for purchases, investment, primary, secondary, because it's really just first paying everybody that's involved. So you have us as the lender, title, appraisal. And so also when I'm saying closing costs right now too, and most people group them together, but you don't have to do this if you're putting 20 or 20% down or more. But I'm also talking about setting up an escrow account, if you guys have heard that term. And that means the taxes and insurance, homeowners insurance, are in your payment together. And so we create at closing for you, in addition to those closing costs of paying all the parties involved. We set up an escrow account, but it's called prepaids because they're your funds that we're just putting into an escrow account for you, because that's how at the end of every single year, your property taxes and homeowners insurance are paid in that out of your payment every single year, and the mortgage servicer pays that for you. So all of that combined and setting up that escrow account, and all the fees of all the third party, it's probably, I always like kind of buffer it to like 2% of the sales price. So like on a 450 sales price, you're looking at 9 grand in closing costs. And that is in addition to whatever your down payment requirement is. And on a primary, you can put as low as 3% down as a first-time home buyer. Then that jumps to 5 if you are not a first-time home buyer. And on investment homes, it starts at 15% down, but honestly, I don't even know why that's like given anymore, because they've made pricing horrendous for 15%. So like Lori put up there, the 20 to 25% down is the range to start out if you're gonna be buying an investment property. And so generally too, going back to the rates on the investment, if you're buying an investment home right now, rates compared to primary, for 780 credit score, which is the best, and I'll kind of loop up into that too, because that's changed over the last year of like all the pricing terms on top of like rates going up in general. The government made it a little bit harder to buy with credit scores and everything. So 780 is the best to qualify. The best pricing tiers in investment properties are 25% plus. So you're looking anywhere between 3/8 to 0.5%, so 0.375 to 0.5% higher than primary rates. So right now, that's around like 7.5 for an investment property if you're buying, and putting 25% down is generally the best pricing tier.
Awesome, that was a good pivot into real estate investing, because this is the
Yes.
investing group.
Yes.
Lori, I want to kind of bring you in, right? Because and I know there's other people here with experience real estate investing. So I'd love everyone, this is like a question for the group and for you to start with. Like, what's the hardest thing? Like, once you have the property, so you've gone through this whole thing,
Mhm.
you've got the property. What is the hardest thing about being a real estate investor?
For me, it's like when the tenants leave and you have to fix the house up again
Mm.
and get it ready and then look for new tenants.
Yeah. What about the group?
That
Yeah.
was interesting. Like go in and clean up and, like contact the property management, that thing, so like, this is what we need to do, and they're like, oh, no, if the house is clean, there's nothing else that when I went in, it's dirty, I have to get like, if I do it myself, it's,
Yeah.
I don't pay nobody else, but it costs time,
Yeah.
so, yeah, it's kind of back and forth.
Yeah.
I would say tenant not paying rent for me.
Oh,
Oh,
non-paying
yeah.
rent.
I had to evict one of them, so
That's
So
crazy.
you've gone through an eviction process. How was that?
not good.
Yeah.
I did have a property manager, but like that's the worst property manager I ever had. So
Yeah.
I had
Wow.
to deal with payments, rent payments, repairs, evictions, so like there's no use of that property manager. And that's why you
Yeah.
had.
Yeah.
So yeah, they made some payments, so cancel the eviction, story starts all over again. So finally I had to get them evicted.
Oh my
gosh, that
goodness.
sucks.
Yeah.
Yeah,
So-
and now it's in the market, but it's slow, as you all know.
Yeah.
Yeah.
Lori, I had a question.
Yeah.
So you said the hardest part is like finding the new tenant / like cleaning everything out. Do you feel like there's a certain budget somebody should have when it's looking like their tenant has given notice they're gonna move out? Like, how much do you think it typically costs to then go and make ready the house again?
Oh, I don't have a good budget idea,
Okay.
but I think, when you're doing calculations to see, is this gonna make a profit for me? You're supposed to include a certain percentage for your maintenance.
Okay,
Like, I've seen anywhere from like 25% to 50%.
okay.
That you just expect you're gonna be spending that much time. That might also include like vacancies, where you're not gonna always have tenants in there paying everything.
Okay, cause that's something I think, and I would love to hear like anybody else, if you budget for like a certain amount, but lately when I've been helping people buy an investment property, they sometimes come to me like, do I have a crystal ball? Like, what's gonna happen next? Like, once we find the tenant and they're there and say they live. I have a very good like vetting process for finding tenants, 9 times out of 10, we get a good person and it's pretty smooth sailing, but I never know what to tell them for like, okay, say 3 years from now, this is how much you should budget for like potential maintenance, you know what I mean? So if anybody here has a property, how much have you noticed you spend on a normal, not the nightmare person, but on the average tenant when they leave, how much do you feel like you're spending?
So you, during the analysis, typically, right, 10% for vacancy, 10 to 15% for repairs, and like you said, they're not talking about like.
The worst
whole
case scenario.
repair, roof
Yeah.
repair, not those, it's.
And I'm sorry, I missed the 10 or 15% of what?
Repairs.
Of
What price?
Oh, like, you know,
Like the rent or the,
the
Annual rent.
annual rent.
okay,
Mm.
okay.
Okay.
10% of annual rent for, like 10% of vacancy for the entire year, 10%.
Okay.
So we are almost like talking about like 1 month of rent you should include for your vacancy plus repairs.
Ooh,
Cause
gotcha.
Cause I basically like sometimes make like a breakdown for them from my like general contractor, like the main repairs, like the paint, you know, like say there was a little like hole in the wall, things like that. I make a spreadsheet of those very basic repairs, so that way people know if they're gonna go through and see. But there's always that kind of like unpredictability and like, no, how much, you know what I mean, is it gonna cost? Cause you don't know what you're gonna get.
And what I have learned is like, that's very low from my experience, like
Okay,
10 to 15% is like nothing, like with 1 month of rent. Your half a vacancy is gone just to make it make ready, right? 2 weeks is gone, just, so 2 weeks of 1
Okay.
month is gone and you're left with one.
So
And
that's
the
like the
1,000
lowest.
Yeah,
that you
that's
should
like
budget.
the least,
Mhm.
we are talking
Bare
about
bones.
new houses or relatively new houses.
Yeah.
yeah,
You
okay.
probably put that in like a separate account, like this is specifically for when the tenant moves out, then I'm just gonna pull that money out. of
Yeah,
my
yeah.
account.
We have a question actually from online, from Laurie. Do you use a property management company? And if not, how much time are you spending on management for repairs, tenant issues, et cetera?
I don't use a property management company. I do it myself, and in general, I don't have to do very much. Uh, like recently, there was a squirrel problem.
Were you out there in the attic with?
No,
like,
no, I wasn't,
squirrel?
No, but no, I had a person who had come before and I just called him and he said, I don't even have to talk to anybody. He did it and then told me how much it was and I paid it. So most repairs, you know, the problem is knowing the right person, like building up your network of people, I think. But once you do that, either the tenant can meet them or you just drive them down there to meet them when they do the repair. I don't find that hard. It's really the make ready between tenants seems to be the most effort. Because that's also when you would do not just like cleaning and stuff, but any major repairs that you might have to do.
So it sounds like that's part of the pain point that we're trying to like solve for with AWIRE specifically is like, who's your
Yes.
squirrel guy,
Yeah.
right?
Yeah.
Yes, like, right, like, or like your painter, whoever it
Yeah,
is,
yeah,
right?
I
You
kind
know,
of think of it that way because like people who have to do that a lot, they maybe know people more than like the average homeowner.
Yeah.
Because they might have more houses they have to fix up.
Yeah. Like to flip it a little bit, since like maybe people are more enthusiastic about being real estate investors, like what do you think the easiest part of being a real estate investor is? Or the best part?
I'll tell you one thing that I was surprised at. I actually like meeting the tenants. And I have like this feeling that, you know, I'm providing a place for them.
Oh, that's really cool.
So I kind of like that aspect.
Yeah.
As opposed to like the flip side is like, you know, you're the landlord slum.
Yeah.
No. Slum landlord, I guess. Yeah.
Absolutely second that. I have tried to do different nonprofit adventures in the affordable housing world, and I found it frustrating, but I feel like I am part of the solution if I'm landlording well.
Well, that's kind of awesome.
Be a great 2/3.
Yeah. What else? Like, what are the other like pitch me,
What's
right?
the positive?
Tax advantages.
Tax advantages, all right.
Yeah.
Nobody's gonna say money. How come, did no one say like passive income? It's super easy, you just cash the checks.
No, it's not.
That was a trick question.
So my husband and I got our what we thought would be our retirement place about 10 years ago, because we weren't saving as fast as the market was moving up. So that rental is a way we can hold onto our property that we cannot afford in the future. In theory.
Like that.
Yeah.
Yeah, that's interesting,
Smart.
like coming back to like the
Yeah.
when to buy, that's something I've heard people mention before, especially in Austin, where the prices can take off from you, is the risk of, I mean, it's the same thing when you're investing in stocks or really anything, there's a risk that the market runs away from you. And this is the best it's ever gonna get, right? You know, because I think we always
I wish I did that. Yeah.
Always think really hard about the downside
Yeah.
price risks, right, which is good because those can be damaging, right? But then there is also the not moving forward on the investment forever and ever and ever, and the market runs away from you to the upside, and this is the best price you're ever gonna get.
Yeah.
Yeah, and then you're farther and farther out from Austin
Right.
in order to be able to find property that will either break even or, make a profit.
Yeah.
Because I don't know, lots of people, well, but Rachel can talk about this, but, like, I think when I first bought my house, it just barely made a profit. But I still wanted to purchase it because of, the possibility of it appreciating. And then it's an asset that I can sell later if I have to.
Yeah. And I will say, I think that that's something that has not changed in Austin since 2003, when I bought my house with my boyfriend. And I was like a legal assistant and he waited tables. And we had a budget in mind and it was $100,000. And we were looking at these condos down at Oldworth. And and we, ran and like we met a professional and she's like, no. You're not doing this. Don't do it. I'm going to show you this little pocket community. It's called Crestview. It's transitional, right?
Yeah.
And we ended up putting in an offer $154,000 and it was a stretch, right? Because like legal assistant, waiter, right? But I feel like in talking to, I think maybe it was kind of at our last meeting, it seemed like there's still for some group of people that same, it may be more extreme, the affordability issue, right? Legal assistant, waiter probably aren't gonna buy a house in Crestview anymore, but the what can I afford, there is, we're talking about taking risks here when we're investing, right?
I think it'd be great if Rachel could repeat the advice she gives her clients, because I thought it was genius.
Yeah.
Are you getting 80% of what you want when you're looking?
Oh,
Genius.
Because, we all have a wish list, you know what I mean? Like in a home that we're living in. And one thing I thought that was really great was y'all bought your future home sooner before you could live in it. And that's something I am talking about with people now is like, okay, say we are looking at this house in Crestview, or we're looking at this home even in Northwest Hills, or even further out, go to Millwood over by Apple Campus, things like that. If this home ticks 80% of your wish list box, and the things that you don't love about it are the countertops, the backsplash, maybe one,
Color on the wall.
yeah, maybe maybe your master bathroom is lackluster a little bit, or the landscaping in the backyard, you have a vision for it, I'm if we can get 80% of the way there with low inventory right now, and that 20% are things that we can tweak and change, I think it's a go right now. I think I'm okay, let's pull the trigger, especially if the numbers make sense, and things work out, or I would say even in the last 3 years, I've had a lot of people come to me being we know that we kind of have an idea of what our forever home looks like, but we're scared of what that could look like 15 years from now. Can I afford that? So I've had some people come to me and be we want to live in Dripping Springs, or we want to have something in Wimberley, and we start kind of pricing things out, even if in those properties meet 60 to 80%, and some other they could slowly add on or do things like that. Those are conversations we're having.
Yeah. Super interesting.
So was that helpful?
Yeah.
Anybody else?
One thing that is one of my philosophies, is kind of related to, does it meet your criteria? Is I think you should buy a house that you would want to live in, and then you're gonna get better tenants.
Oh, as an investor.
As an investor, yeah. And well, living in my rental house is always my backup plan.
Pretty nice.
No, so I do think you get a better quality tenant because it's in a neighborhood you like, it's a layout of the house you might like. It might not be as perfect as you would want it if you were living there, and you might make changes right away. But I do think that helps for the rental property if it's closer to what you would like.
That's very interesting that you say, because sometimes I have investors come to me to like buy investment properties and we go start looking at things and they're like, I don't really like how the sink is like this in the master bathroom. And I'm like, okay, we have to look at this as like a bigger picture, you know what I mean? Yes, you would prefer the sink to be over here. You would prefer the shower tile to look like this. That's not what everybody's gonna want sometimes. So when I am showing people like investment properties, sometimes they are more cookie cutter, like more open floor plan, more 3-bedroom, 2-bathroom, like a little bit more copy paste so that multiple people can see it being the right fit for them. So I try when people are buying investment properties not to get too specific on like their wants in a house, because at the end of the day too, like they aren't, like I'm like, you're not gonna live here. You may live here, you may live here in the future, but like 9 times out of 10 you're never gonna live in this home. It's just an asset. So like what can we look at that the majority of the people are gonna want to live in?
So do you have certain things that you suggest in
Yeah.
investment property, like it should always have 3 bedrooms and 2 baths, or
Yeah, like I would say right now, like a 3-2 to like a 4-2 is good. Sometimes I've had this year, people come to me and be like, I love this little condo I found downtown and I think it'd be a great Airbnb. And then I have to tell them that the like HOA fee is like $450. And I'm like, let's look at the numbers like on paper, you know what I mean? So right now for like investment properties, one thing I like to track is where are the production builders going, where is business going? Like we know like in Taylor, the Samsung plant is like happening over there. Where are these major production builders putting their money, you know what I mean? And so we kind of start to look at like the rents out there, because when a master plan community comes, for example, it's almost like built-in equity, because as the builders have new phases, in each phase they up the price, and so that's kind of building in equity for people. So
really?
yeah.
New homes are quickest appreciation.
It's like the
Yeah.
quickest appreciation, like for a good example of this was like Easton Park over by the airport.
Yeah.
Like 5 years ago when Easton Park hit the market, I had some friends buy a house for like $295,000 there. There's homes in that neighborhood now, 700 grand. So, you know, it's following the builders, it's following where the money is like going, you know what I mean? But yes, I think in the future, I mean, again, I don't have a crystal ball. If I did, I would be a very, very wealthy woman. But I think like as Austin grows and as Texas grows, like we can't make more land in these amazing areas like Crestview and stuff. So people are gonna start moving out. I do think like Leander, even past that, like Taylor, some of these places are gonna grow, especially as more development happens out there. And so right now, that's kind of where I've been like guiding people to buy investment properties. If it's something they're not like living in and it's just about the numbers and where is the appreciation really gonna go. Does anybody else have any food or thought on that? Because I would love.
Yeah.
So I want to actually go back to what Laurie was saying about finding the place that you would want to live in. My investment property is where I used to live. So it's in a part of Chicago it's a northern suburb of Chicago that doesn't have a lot of new construction. My ex-husband and I looked for 4 years before we found this property. And then it was, you know, by that time we could afford it. It was like 2011, so it was perfect time to buy. It was bottom of the market. And what made me decide to make it into a rental property, when we got divorced and I ended up with it, is because it was, you know, limited new construction in that area. And also because I've lived there long enough to know that like, it's the quality of tenants, that those properties attract. And I've had 2 fantastic sets of tenants, and also those places sell like hotcakes. So I know that, you know, once I stop enjoying the passive income that's coming from it, and I'm gonna be holding on to it a little bit longer because I'm putting a lot more money into it this year than I would like to.
But I know that that's a big chunk of change. It's gonna help me with whatever, somewhere down the road. I'm keeping it now because passive income, also because I might have reason within the next 10 years to move back to Chicago. And so that gives me an easy way to get back to a place where I know I like living.
I love that.
So, but if that shouldn't come to pass, then, that's a lot of money that I can use for something else, should I choose to, or leverage into a new property.
Yeah.
So.
I think that's super smart. And but I like hearing you say that because sometimes two people come and they're like, they are just buying their first house, they're not quite at the, like, it's an investment yet. And so I do like to share those kind of stories with people because they're right now with interest rates being a little bit higher, that monthly payment scares people, and I'm being fully transparent about that. They are pretty high right now. But I do talk to them about how they could leverage this property in the future, especially if they like hold on to it. It's a little, you know what I mean? It might be the smaller house in Crestview right now, but if it has a lot of potential, they live in it for the next 5 years, like fix it up a little bit. It's gonna be a great rental and it's gonna be a great asset going forward.
Yeah, I had a comment and then a question. The comment is, there's a lot, going back to like where the construction is happening and growth, and I'm in the energy industry, and there's a lot in semiconductor, it's
Yeah.
booming, there's a lot of money coming in, so it's interesting to observe where the money ends up.
Yeah.
What companies come to Austin, and of course that means growth, and that means people moving in, and so it makes me feel bullish about the future in that sense. So that was my comment. And my question is, how do you feel about townhomes, condos versus houses? Because I ended up purchasing a townhome that has, is attached to another unit on one side and then not on the other. And it was perfect for me. It was like, I do not want maintenance of any kind. I'm okay with the HOA at the time, and it's kept, about the same, maybe $100 over, but when it's time to sell, any thoughts around?
Yeah, I mean, I typically like tell my sellers that townhomes, unless it's in like the greatest location in the world, may take a little longer for us to move. They're not gonna sell as quickly as the single family homes. So I typically tell them like, let's buffer in extra 2 weeks to like a month, just in case, because sometimes the townhouse, depending on square footage and bedroom and bathroom count, or like yard, for example, doesn't tick as many people's boxes. And so I do prepare people for that. But overall, one thing about real estate is it is more of a buy and holds. I tell people, if you're not gonna live in this for, like, you only see yourself for 2 or 3 years here, this may not be the best place for you to put your money at this time. If you're gonna hold on to it for 5 to 10 years, I still think a townhome is a good investment.
I have a lending perspective on that too. So townhomes for pricing is technically, they're categorized as single family homes. But condos are always looked at very differently as a lender, because condos have the HOA third-party management system that are managing the budget, litigation, all sorts of stuff that we have to go through. And in addition to qualifying a buyer on income assets credit, we have to qualify the homeowners community of the condo association. And it has to be warrantable, is the term we used, that everything that we just mentioned, like the bylaws, the budget, everything is in line. There's not too many investors in the community, that there's like a ratio of how much owner occupied to investor occupied. And that would determine if your condo is warrantable. And warrantable means that it's easy for lenders to finance. If there's anything that's like outweighed in that, then it causes your home to become unwarrantable, and that's very hard to finance in conventional financing.
Yeah.
I just actually got that question from a client that had like, she's trying to sell her house and she's had a bunch of floods and all this stuff, and they're about to have all these lawsuits within the community. And she was asking me if that was going to probably be hard to sell. And yes, if that comes up, that's going to be hard to make that warrantable.
For what community?
Oh man, I can't remember now. Yeah. But it was like one of my friends and she was calling me to ask that.
I've had people call
Yeah.
on, like buyers come to me and be like, I found this amazing condo, I love it, and like, unfortunately, the lenders can't lend on it because it's unwarrantable, and so
Yes.
I'm like, those people are definitely having a hard time selling, but I know you guys asked a question about foundation. About like listing or like even on the buy side, typically, if my clients find a house that they're like, we love this is it, it's 90% of all the boxes and it has foundation issue. My biggest question is, has it been repaired and is it repaired with a lifetime warranty that's transferable? If it's not repaired and there is no warrant, or it is repaired and there's no transferable warranty to go with it, then I tell them we should keep on keeping on.
Yeah,
Leave
they
it.
have a warranty, but the foundation person isn't. like-
So was it already?
Yeah, okay, so when we bought the house, it came with a 10-year warranty. That
Because you got
warranty,
it brand new.
no, it was used.
Okay.
So our 10-year warranty expires in 2026.
The home warranty or the foundation?
The foundation warranty. for the
Okay.
building.
Okay,
And so we're like, okay, we need to take advantage of this warranty for 2026. So let's start getting those claims. We did it twice, both times it was rejected because the numbers weren't trending upwards. But there is absolutely foundation issues. I mean, like the tiles are cracking, there's like cracks and load bearing, there's like obvious cracks, the list goes on. But they're like, no, the numbers aren't meeting that like of the specification result, so we can't deem it as
Yeah.
foundation issues. So we're like, okay, well, clock's ticking, we gotta either sell it or rent it, but if we rent it and we never get that warranty. If we never, accepted, then now we're stuck with a house that has foundation issues and we're just kind of screwed either way, because either we don't get the warranty, we have to pay out of pocket to get it fixed.
Yeah.
Or we fixed it and now we have a house that has foundation issues, which I've heard is like, once it's dinged with foundation issue, it's really hard to sell. So now we're like, we should just get out of the wall.
it's not as scary if it, I personally don't find it to be as scary if it's been professionally repaired. Like, again, I know that's an expense to you guys, especially if this home warranty isn't gonna like pay for it, you know what I mean? I know that can be a pretty hefty cost. That's why when buyers are looking at it, I'm like, has it been already repaired by somebody who is like a trusted source, all the receipts, all of the like warranties, like documentation, is it transferable? So I guess my question is like, are you guys reaching out to the builder then for them to come out and try to like repair the foundation?
The builder.
Or is this a third party you're
It's
trying
a
to hire?
third party, it's called structure, and then it's a third party of the builder themselves, so the
Okay.
builder buys this 10-year warranty.
Okay, yeah,
And we reach out to the third party.
okay, and they're just not coming out,
So you two have carefully read the paper.
Oh,
You know that warranty is.
Oh, yeah.
And it is strictly a numbers game. There's nothing in there that you feel relates to what you see. When you see broken tile, you see things that seem messed up to you. There's nothing in the language that you feel you can put your hat.
I've done it, but it's like they go out and they take measurements of every
It's
point.
strictly measurements. There's
Exactly.
nothing else in your warranty that could tick a box to say, now you have to come deal with this.
yeah.
I think the word that they use is like,
Otherwise unlivable,
unlivable.
unsafe, otherwise unlivable, and I see that.
It's like unsanitary or
Unsafe.
Yeah.
What, have you thought about getting like a foundation company or an inspector to go and get their opinion of it?
I should reach out, but they need their own employee to come out and say, their recommendation was, it's different, like, we had them come out 2 different times in a year, so it was like one rainy season and one real dry season. So like, they're like, the numbers are making sense, the house shifts, but like, you wanna get it 2 back-to-back rainy seasons in a row. So now we're like, okay, so August, we're gonna file another claim.
Who built this house?
Yeah, Ashton Woods.
Okay, I'm just curious, because yeah, I mean, I don't have a lot of like experience with like Ashton Woods as a builder, like I haven't sold a bunch of their homes, but I mean, they are reputable, they have, I mean, they're pretty much everywhere.
Can you explain why you made the face?
I think it's I think it's gonna be something that's, you're gonna end up having to pay for yourself. I don't think, just from based what you're saying, I don't think you're gonna end up finding, like, I think it's gonna be a never-ending loophole. Unless like by some miracle, somebody comes out and is like, wow, like, we agree all of a sudden, I think you're gonna probably end up having to pay for this, and I don't think it's gonna be cheap, unfortunately. Which that's kind of, I'm like, shit, that sucks. And two, yeah, then it's gonna take longer for you to sell, because you're gonna try to like recoup this cost that you just put into it.
Yeah.
But it would make me nervous, I think, like, just hearing that, like, okay, say they did fix it, but then maybe they don't provide you a transferable warranty for somebody else, then it's gonna be hard for you to sell, because I wouldn't tell a client to touch it with a 10-foot pole unless it did have those things.
Yeah, and that's actually very valuable, because that's something we didn't check with the structure, the third party, we don't know what warranty they offer afterwards. So if
Yeah.
we do find out that, oh, they will come to fix it, and then they don't offer any warranty, then we might as well just sell and get out of it now. And not ever have to worry about it, because technically, the house doesn't have foundation issue.
Yeah.
And
But that's why you
Okay.
don't wanna hire somebody who's gonna look at us.
Yeah.
Because right now, when you're doing your seller's disclosure, you are sharing what the experts have told you.
Right.
They're
Yeah.
telling you it's fine, but it sounds like it has been a pain point for you guys. It's been a big stress for a while.
Yeah,
You might want to invest in an hour or two with a real estate attorney where you take your
Yeah.
warranty in and you say how they are reading this when I make a claim. Is that okay? Is it not okay? Is there anything you can do for me? So that you know when you're paying for the foundation work, you had no other choice and you really did need to pay for the foundation.
I would agree with that too, because like, as a licensed realtor, there's only so far that like we can like legally advise you, you know what I mean? I can't give you any legal advice. So when I think it comes down to like very specific documentation like that you received from the builder, or any of these warranties, I would sit down with an attorney and like truly like go over everything. And then again, like she said, to your knowledge at this time, there is no foundation issues. Nobody has told you specifically this is what's going on. So one, I would potentially try to get out of it and disclose within reason. Like, if you think it's gonna get you in trouble later,
When in doubt, disclose.
Yeah,
And if
like-
you're disclosing everything.
Go
so
ahead.
far Your file says. There's no problem.
and you can like provide those. I would then, to cover your own asses, provide all of this paperwork that says that there isn't any foundation issues. You've had people come out and measure, you've come and like had people look at things and they have told you no, there's not. I think if you provide all this paperwork and you go ahead and get out of it, you may save yourself some money if you're like, oh, we don't know what we want to do, and you end up like holding it for a while and like using it as a rental. I would just then start saving your money in case it does come up to a point where you end up having to repair it. But right now, yes, you could sell it, and it's, to your knowledge, there, in all the paperwork, there is no foundation issues.
Maybe still on our word.
Yeah, so I would maybe say get rid of it.
Yeah, but from
Yeah.
an investor perspective, finding a place that has a foundation problem can be great. Because so much of the market is afraid of that, they're not bidding against you.
I was gonna ask that, I feel like last time I was in the real estate market, someone said, oh, every house in Austin has foundation problems. Because the soil is clay, right?
Yeah.
And so like, maybe it won't have as much of an impact as if there's enough demand as you think it would. I mean, do people say that, or was
It
that?
wasn't, I mean, it's really like, for example, like, I guess even when the market was like crazy hot, like, if my clients found something, and obviously there were gonna be multiple offers, if it had foundation issues, and yes, that typically took away like 10 or 15% of the other people in the market would like run away from it. So we weren't bidding against as many people, but it had all the warranties, it had everything that they needed, and I was like, okay, it ticks all the boxes. We even had a specialist come out and look, the repairs were good. They bought it and it hasn't given them any issues since, so I mean, Yeah. There.
As long as it doesn't look like that house on the side of the cliff in California. Right?
Yeah.
You're maybe okay, right?
Thank you.
Get rid of it.
I'm glad you brought that up. At the beginning, I mentioned about my friend who the house got vandalized before she closed.
Mm.
What happened is, it not only got vandalized on the walls, but also the teenagers that went in, opened all the faucets.
Oh my gosh.
Flooded.
Oh, no.
And so what the real estate agent told her, advised her is that do not buy it, because now you will have to disclose that it was flooded at some point.
Yeah.
And even if the construction company comes and actually removes it and cleans it up, and
Yeah.
there were like so many issues there with the fact that it had already now water all over. So I don't know, it was, so obviously she didn't buy
So
it.
unfortunate.
But she got a 4.8% rate, and she's like, but the rate. Yeah.
I don't care about the house. Yeah.
Yeah.
I have one question I want to comment. Question for your friend, did she get her earnest money back when she back?
Yes, she got everything back.
Okay, good.
Everything back, and they offered her another home that was intact. It
Oh,
was
good.
it had 80% of what she wanted, not, 99 like this one, but it's just like, so she talked to so many people that were like, do not touch it with a ten. They're going to rebuild it, and it's gonna look exactly the same, but you will forever have to disclose, and later on, maybe there were some issues that will come up, and you have to pay for it.
Is it brand new?
Brand new house.
So it was like like some teenagers went into like a neighborhood where the builders were building and they were like, oh, look, the window's open, and
I've
they
actually heard that
went,
happening.
and they just went and
Yeah.
go berserk.
And like.
Those little
crack the
mofos.
walls,
I know.
Honestly.
Open the faucets, overnight water.
Yeah.
everywhere. These kids.
I know.
I've heard about.
Yeah.
Oh, yes, and another factor, and this is the last thing I'll talk about, foundation issues, because I feel like it's gonna, our mortgage is like 2%. So my realtor's like, don't get rid of that sweet mortgage, and I don't want to, but.
People
it's
are
just so
gonna have to.
complicated.
I
Yeah.
think we all have to
Yeah.
adjust our lives to higher mortgage and
Yes.
interest rates. Let's all just
Yes.
move into 2023 and 2024 and, you
Yeah.
know, not
I guess
make a ton of decisions based on our rates. from-
I guess the question
Yeah.
there too
That's
would
fine.
be like,
100%.
what are the rental comps in the neighborhood? Like, if it's actually something that's cash flowing a good amount, like if you're making, say, $500 a month on it, then
Yeah.
We would make
So-
maybe like,
it is.
you can talk to the builder at all, just to say, hey, listen, there's an issue to this house, I think you have a warranty that's supposed to cover everything, put some builders out there that will actually look at it, take care of it, try to help you guys, just because of the reputation.
Yeah, I would even,
Yeah, I will reach out to you that again.
oh, I would call Ashton Woods and be
Okay.
like, this third
So-
party said sucks.
So lifetime foundation warranty and then mortgage.
Yeah, I would-
Okay.
Yeah.
I thought the builder only warranties to the original owner and not the resale, is that not true?
That hasn't been I haven't had that. Typically, we've been able to like transfer the warranty to somebody else.
But it's something to at least look at the warranty.
Yeah, I mean, I highly recommend always like taking your paperwork, like since these are legally binding documents, to a real estate attorney and like going over things if you ever have any questions about contracts. Again, as realtors, we know a lot and we know what we're licensed to tell you, you know what I mean? But these are legally binding contracts, and with builders, we don't write the contracts, you know what I mean? And so I highly recommend if there's any little questions that people have or concerns, to go ahead and sit down with a real estate attorney. I think it can never hurt you. It can only give you more power.
This person is that.
Yeah, this is for, Megan, I have a question about like,
Morgan.
refinance, like for the
Yeah.
investment home,
Uh-huh.
cash out finance.
Yeah.
Good one, yeah.
Yeah, you can definitely do that. So in Texas in general, homestead laws, primary homes, but anyway, you have to keep at least 20% equity in your home when you refinance. Again, like best pricing would be if you have a 75% loan to value, so keeping 25% in the house. But cash outs generally are always like 0.25%, 0.25 higher than where we are market. So, I mean, I would maybe even just wait, yeah, to when rates drop a little bit more, because then you can, what's your interest rate now?
3.5.
Oh, well, again, you can take out a HELOC loan on it, and not have to, yeah. Yes.
So can you do a HELOC on the property you're not living in?
Yeah.
Yeah, it's not, it wouldn't, it's like not necessarily like a home, it's a home equity, like a HELOC
Just like
out of
a
your
line
house,
of
but yeah,
credit, like
yes,
a
it's,
secured
yes,
line of credit?
yes, yeah, instead of like actually redoing your first lien mortgage too. But yeah, again, like you said to Sarah, like people are gonna have to like let it go, you know, the rates, because like there is tappable equity that people are gonna want to get out, but like I mean, just make it make sense to you, because like I mean, the people that like at 5% are waiting to refinance, so like over the next several years, like these people that got into homes at like 8% can still do a cash out loan and get way lower rate than what you would have been getting today, you know, so, but yeah, you can definitely do a cash out. Yeah.
What else is in people's minds? I have a couple of
So I actually have to get going soon, but this is my first time coming here.
Yeah.
Is this every month, every?
So, this group, AWIG, Austin Women's Investment Group, is every month. And you can find us on Facebook or Meetup, and it's different topics. So it's not always real estate, but then we're starting this new group, Rachel and I are, where it's gonna be more informal and just, well, kind of informal like this, where it's just some people who are interested in real estate. And we'll just meet like at a coffee shop once a month and talk about stuff, maybe have some presentations if we come up with a topic that people are interested in. And yes, that one is Austin Women Investing in Real Estate, and that's also a meetup on Facebook.
Yeah, and we'll meet like once a month.
The AWIG or the AWIRE?
Both of them will meet once a month at different times, yeah.
Are most of the events posted on Meetup or Facebook?
Both.
Events are gonna be on, mostly on Meetup. Facebook, at least for AWIG, the way that we use it is sort of like a connection hub between meetings, so people discuss or if there are questions, but the.
We usually manage to get an event up on the Facebook group though at some point. Sometimes it's like 24 hours ahead of the event.
Yeah.
We're a volunteer run.
Yeah. The best place to keep updated with the events is Meetup. And then to sort of network in between is Facebook.
Oh.
Yeah.
And y'all do it in different libraries.
Yeah, different libraries, yeah.
We try to keep.
So
it,
we have
yeah,
some down south
free
and,
with enough space.
yeah,
for
some
us
up
to
here.
And what we've done in the past is on YouTube. Like,
Yeah, we do have-
Yeah, we have a YouTube channel too.
Yeah, yeah, Austin Women's Investing Group.
Austin.
Oh,
Investment
cool.
Yeah,
Oh,
Yeah.
okay.
yeah, it'll all come up. Do you actually right this very second? Because I was gonna ask you about house hacking, because I don't know what that is.
Oh, yeah.
You have like 1 minute to tell me
Super
and everyone.
curious.
Because you said, yeah, because you said I'm a house hack. Isn't that what you said? Like
Yeah.
I'm house hacking?
Yeah.
Okay, so for
Mm.
those of us who maybe are like of a certain age and don't know what that term is, it's like, what is that?
It's basically, I think it's a new term. The act itself is quite, I wouldn't say old, it's
Yeah.
just something that I think many people have done.
Mm.
So basically, you live in the primary residence and you rent out all the rooms and sometimes even the garage, so that people pay the majority of the mortgage, and either it can be passive or we pay just a small amount
Yeah,
of the mortgage.
yeah.
Yeah, so, I was already going to do it, but I learned about it when through Market Watch. There was this guy who became a multi-millionaire through house hacking strategy
Yeah.
in Seattle.
Yeah.
He was doing it, he called it house hacking on steroids, so in, like, every single year, he was buying multi-unit properties or just a single family home, renting out the rooms, the garage, and then just doing it over and over and over again.
Yeah.
And then eventually he moved into wholesale real estate, I think flipping, because he was acquiring so much money.
Yeah.
I liked his particular strategy, but I also like the fact that his wife has a 9-to-5 job, and she's also an accountant, so they have the benefits from that job, which is stable. But they also have the unpredictable higher income from the entrepreneurship.
Yeah.
So that is the balance that I want for myself and whomever I'm hearing.
Yeah. Whoever has this exact set of skills that I need for my business.
Interviewing accountants.
Yeah, whomever, but so I just figured that's a strategy that I could employ at least a year every 2 years, while also looking into these other strategies like flipping and wholesale, because I was really staying away from flipping.
Yeah.
Mhm.
And then I realized that I could do it as a group, and I haven't done it, but I've met other people who are currently doing it.
Yeah.
I think one woman, she invested like $7,000 instead of this other friend of mine who invested like 20 to 30,000.
Yeah.
And I asked the woman, I said, how much did you accrue a lot from it? She's like, oh yeah, it was much bigger than what she expected once that was sold.
It's been very.
If I could add to the house hacking part, even duplex or fourplex or triplex, any of that would count as house hacking too. So currently I'm in a duplex on one side,
Mhm.
so renting out the other side. Usually if you're primary, you cannot deduct insurance or interest rate or taxes, but with the duplex, I could half of my insurance, half of
Mhm.
everything basically. So that's a big advantage. And with the if you're in a fourplex, you could be living in one, this is typically for someone that's starting out, right?
Yeah.
Mhm.
You're in one unit, so it's probably covering your entire mortgage.
Yeah.
Because you get to deduct, like 3/4 of your insurance, mortgage, taxes, and everything you could deduct. The
Yeah,
primary
and
cannot.
I mean, I think I get it, like, from the duplex, triplex, perspective. It sounded like with it being your primary residence and with like roommates who are paying your mortgage, do you get the benefits of being, it's not an
No.
investment property, it's a personal
No.
property
So
that
this is-
these
yeah,
people are
so-
paying
Yeah,
everything
this is-
for you.
Yeah,
It's
this
like
is
for
the primary.
saving.
So I have an
Yeah.
accountant and I asked him, what should I collect? And he said, collect all your utility, all the utilities. He said all of the taxes, any home improvements that you've done. If you're renting out a garage, go ahead and collect that. And he said, I want you to put it in a spreadsheet. And he said, he'll give it to me, and that way you can write off all of those deductions for me. Because it is a primary residence.
But you have to separate out what you are using as your residence, and then what percentage is being used as like an investment? Am I
Not-
overcomplicating this?
Well, I mean, it's,
Yeah.
because it isn't, it will become an investment once I move out and then I rent out my particular room.
Yeah.
But so far as my primary house, I could still benefit from those 2 tenants because I can just rent them since I'm providing housing for them. So then he said, collect all the rent. He said, collect all everything that you're collecting from them. And he's like, even when it's going toward the utilities, he's like, write all of that down, the amount every single month. And he's like, just go ahead and send that to me.
Yeah.
So that's enough for like tax deduction.
Yeah.
I wanted to get into multifamily units, but they're extremely expensive
Yeah.
over here.
Yeah.
But where I was living before, with my ex over in Killeen, they're much cheaper.
Yeah.
but
Oh, yeah.
I'm not trying to live in Killeen.
Well, one of the things was, is it even possible to buy investment property in Austin right now, like from a cash flow perspective?
Can we talk about that from a house hacking perspective?
Yeah.
When you're just barely making it into your first house, you're a single female, but saving, you're looking maybe a 1-bedroom condo or a 2-bedroom condo. If you're thinking house hacking as a safety net, well, if I get laid off and I'm trapped in this mortgage, that feels really hard to me. But if I've thought about it ahead of time, I've listened to my realtor and I've gotten a 2-bedroom, 2-bathroom instead of a 1-1.
Yep.
I have a safety net of I can always get rid of
Oh,
it.
yes.
I can stay here, I can have my life, it will be great, even if I get laid off.
That's.
And I did get laid off last year.
Oh, wow.
It was, I was working in tech and like.
Oh,
they
wow.
laid- Not just me, but my
Yeah.
entire team off.
But you were okay, because you thought about
Exactly.
it.
It worked out heavily.
Yeah.
And that's what I've been like telling my like single female clients who like work in tech, like right now, like I would say I have a healthy amount of clients who are women from like 23 to like 35, you know what I mean, who are just single, and there is that fear like of not having that dual income protection, and that's something like I experienced myself, but yeah, they have like bought 3-bedroom or like two townhouses, and like you're like, I live alone, I don't mind renting out the room, you know what I mean? And so one of my friends, yes, I helped her buy a house and she rents out her 2 other bedrooms. And then she lives in the master. And it's given her that ability to even like build her nest egg back up after liquidating some of her money to buy the house, you know what I mean? But I think that's something to like always prepare for too, even when you're like talking to like, even if it's not you buying a house and like your friends come to you to talk about things, like it's a good possibility. I think it's smart. That's what I would do
Thinking
now.
about like what, like the extra bath, like splurging for the extra bathroom, right? Where maybe you're paying a little bit more, like if you're out looking, like, oh, like, yeah. A
Yeah, it's
two
not luxury,
is better than a 2-1, right?
Yeah.
You can turn it into money very easily.
It's super important.
And it's so smart to like landlord experience from like a very minor perspective,
Yeah.
and then you just grow.
Yeah, like relatively low stakes, you learn as you go, and you set up your
Yeah.
system, and then you scale it.
And this, and this is like more,
I didn't mean to hold you up, but I'm so grateful that you stayed.
Yeah.
So I'm just saying, what else? Because I was like, what is the house happening?
and
Yeah.
like more, I guess, like extreme perspective. Like you mentioned that somebody even converted the garage. I did have a client do that. She did like, she had a more liquid, money. So she did buy a 3-bedroom, 2.5 bathroom house with a 2-car garage. And she did convert the garage into a studio. And it has its own separate entrance on the side of the house. So it has its own little like front door and stuff. And I think she rents it out for like $1,300 a month. You know what I mean? She's in a decent.
I know.
Yeah, rent is so expensive in Austin.
Stayed out there this weekend.
I know.
In a decent, yeah, she's in a decent location, you know what I mean? So like, I think she's in like, I'm not gonna say like exactly, but she's in like 78745. So like just on the other side of like Congress, like Ben White. So she's.
Yeah.
I was like, I'm not gonna disclose your address, but like, but I will say that's a great zip code to like be in, and so she's, yeah. And I don't think, I think she cash on her house that she lives in, like, cause she's renting the 2 other bedrooms out and the
Yeah.
garage. I think she's bringing in, I think like 600 a month. But again, that's not for everybody. It's,
Yeah.
Isolation of the garage, like I was thinking about it, it's.
Yeah,
changes
yeah.
constantly.
They, like,
There's no
added-
insulation on the garage.
So- yeah, so she did redo it, so it is like insulated, like it has a kitchen, like, I mean, she basically, yeah, so she like did add in like a little kitchenette, like, I mean,
Not count though for an appraisal, like they don't count that as square footage.
yeah.
Yeah.
So.
So they will, when you went to resell, they don't
Yeah.
count that, yeah.
No, so
No.
unless it's like permitted,
Yeah.
you know what I mean, kind of, all
That's
of
the
it.
only thing, yeah.
To be careful, but like for her specific needs
Mhm.
at this time in her life, like her goals and her mindset, it very much works for
Yeah.
what she's wanting to do at this time in her life. So I understand that's not for everybody, and it's not something that I approach people with to say, you know what,
Yeah.
let's think about this to get you into a house. She came to me with this idea. And she's a very strong-headed person, and we looked at all the numbers, and I told her that, hey, this also for resale purposes isn't gonna be for everybody. There is a very high probability that you will then need to reconvert this into a garage in the future when you go to sell it.
Mhm.
And she was like, she understood all of those things, and so I said, okay, homie, once you buy this and you wanna do this, this is for you to figure out. But yeah, there's some things that need tweaking there, but 78745 is a hot zip code right now.
Good to know.
I was about to be like, I'm gonna door knock on you guys, like, wait.
Rachel's great friend reminded me to ask a question of Morgan.
Yeah.
We have talked about, and I think it's a conversation.
Hi. Hi. Yeah.
I want lenders to start having products for women of a certain age who are looking to retire together, but not in the same kitchen.
Oh my gosh, I would
Housing in a more
love that.
flexible way. When are we gonna get products that let that happen?
I love.
I don't know, but I hope it's on the way too, because that's like exactly like I talked to my mom and I'm like, what do you want to be? She's like, I just want to live with all my friends and like share a, yeah. And I'm like, that's what I want to do. Like all my friends are already talking about that's what we would want to
It
do.
seems like there's a wave of interest and. one
Yes.
isn't Meeting it at all.
Yeah, no, nothing's really like
you-
structurally there, because you'd have to all be on the loan together. And yeah,
Which I think,
yeah,
I feel like that could be okay though, to like all be on the line together,
Yeah.
if you then had an attorney write up like an agreement of like
Yeah.
assets, like, okay, this is how much I put in, this is how much they put in. If we appreciate, this is the percentages people get back in case friends decide to go separate ways.
But there's a chicken and an egg. Like,
Mhm.
if there's a mortgage product and builders are gonna start building where we.
Like
have those
compound
that
housing,
are
yeah.
competent, But the builders aren't gonna build it if there's not. a
If there's
dedicated
not-
loan product supported in the market.
But
Yeah.
what would that look like? I guess, what are you? Cause is it like a more, cause like, again, are they, the builder building a more affordable floor plan, like not necessarily as large?
It's a different floor plan where you have distinct private areas and distinct.
Yeah,
common
not like a
areas.
mother-in-law suite, but yeah,
not
but it's
built
like,
for
yeah,
nuclear family, but built
Yeah.
for a different living arrangement. It's one story, everything's universal design, because they expect age.
Okay.
But
They
the
could
why,
get a premium.
but the mortgage product, why does the mortgage product have to be separate
Yeah.
from a single family home mortgage?
yeah,
Product?
It's just easier for that demographic, I think, because then you don't have to go find a specialized career, of which there's probably not very many.
Oh, like somehow
to
the
draft your-
mortgage like incorporates this idea of like a breakup like in the
Right, so
family-
it would work more
in the
like a
units?
condo regime
Yeah.
in functionality. But until there's a way to fund it, the builders aren't gonna build it.
Yeah.
there's not an actual like property type of it, but yeah, you could do it now. It's just like everybody has to be on the loan with, if they're a primary occupancy. And like everybody has the same like liability on the note. Because also like we can't do, like a lot of people have like overlays in companies that like people always try to like throw all these people on the deed. Like you're like, who are they? No, we're like, stay off the deed. Like, no. Yeah, they're like, we also want to add our friend Joe on the deed. I'm like, no. Like, yeah, like, no, you gotta, everybody's gotta be on the note together and deed. Yeah.
Then you put that if it's spend down issue,
Yeah.
where if you're on a team, you have to sell the property to qualify for the nursing home and end of life. Like the deed and the title stuff gets really complicated once you get a certain age.
Mm-hmm.
But it doesn't
Yeah.
have to.
And this is assuming that everybody who lives in this communal living situation wants to be an owner.
Yeah.
Yes.
I feel like that's like everybody needs to get together on that, like the real estate attorneys, like trust, like everything together, like the family law, like for making wills
Yeah.
and stuff, like,
Yeah.
yeah, no, but I do think that is like a wave for sure. Like I'm seeing that everywhere and all, yeah. And like Rachel and I talk about it too, because the cool thing, like Forbes even put out like an article and a bunch of others, because like I started noticing this personally, but I didn't like know how to quantify it, but anyone that is like single that is buying that I work with is a woman, like not men, like it's very bizarre. And so it was like an article that came out that like most, like there's a way higher percentage of something like 30% more than men that are buying single homes. Yeah, and I just feel like I'm hearing so much more of like the compound living with women too.
It's been
like, yeah.
approached to me like
Yes.
a lot over
Yeah.
the last year, like a lot of my friends and clients who are women in there, like who are just single. I'm not even gonna put an age on it because that doesn't matter,
Yeah.
but like a lot of people have been,
Cross agents.
yeah, it's across the board. People have been approaching me though about,
Just like
we just want
friends.
to buy a house
Yeah.
together, like and they're like, we're not lovers, but we just want to live in a communal way. And I'm like, I don't care what you guys do. If you're lovers, if you're not, like live your best life, you know what I mean? But it's been approached a lot lately and I don't have all the answers for it, other than to advise them to talk to like attorneys after like the purchasing
Yeah.
of the home, you know what I mean? To then divide the assets. So if anything happens, things are fairly split, but
Oh, yeah,
it's been hard.
that was a thought, because as like people buying as spouses, like if, you get divorced or something, you can create like an attorney, like an ulti lien, like where you have to pay out somebody
Mhm.
to, but you don't have any agreements like that, like if you stop being friends, you bought a house together,
Yeah.
like you both, like, and one was like, oh, I'm not selling the house, I'm not selling the house, like you're both stuck in it. So like, yeah,
That's
with
why
like,
there's legal
yeah, the
agreements.
legal agreements with like a marriage is you have to pay someone out, or they have to have an option to sell the house, pay out the equity. And that is community property, because we're a community property state in Texas.
Which I think is.
Yeah.
I think would be fair if you went into into the agreement of buying a house together, that if one person decided that they no longer want this. Okay, well, in the agreement, you.
Be a lot of
You
handshake
owe-
agreements.
You
Yeah.
are the person that was willing to sell. Yeah, you guys would have to figure it out.
Yeah.
So.
We have one more minute probably for one more question.
I was just gonna add to that, you wanted
I
to.
think you're on to
Yes,
something.
okay.
Yeah.
In the condo complex where I live, we only have 26 units, and I think 70% are all single, like.
Yeah.
Whether widow, divorce, whatever the case may be. I thought that was very interesting. and
Yeah, they have 55 and up communities, but not, yeah, women.
But
Yeah.
there is something to be
But
said about
what's
the
funny,
trend.
due to fair housing laws too, it's not like we could be like, women only neighborhood, you know,
Yeah.
but like. So people want to get together and secretly
Yeah.
have a.
It's a women-led neighborhood.
Yes.
A women led, yes. Yeah.
Or anybody who
cool.
identifies as a woman. Or,
Yeah.
This is super helpful.
Yeah, this was fun.
Everybody for sharing. Is there any like one last question that you want to get in? And I think that we'll kind of be milling around for a little bit while we're closing our shop. But this has been, I mean,
Yeah. So,
yeah.
so yeah, if you guys want to talk about real estate in the future, we'll be sending out events on our Facebook page, the AWIRE
yes.
Facebook page and the meetup group, and then you can just join us.
And the talks will be very much kind of just like this, where like if you, because they're not always gonna be panel style like this, you know, or like a presentation. The goal for like AWIRE is to like meet in the evening, just people who have interest in investing in real estate or have questions or like need a resource for a squirrel guy or like something like that. Just like a place for people to come and like brainstorm ideas and like shoot the shit.
Yeah.
So.
I mean, I think that like that someone bringing that idea of like, I'm gonna convert my garage into an apartment, right?
Yeah.
So it's
Yeah.
exactly the right place. to
Yeah,
kind
yeah,
of
to talk about that. Yeah.
figure that type of stuff out. So this, so that's so great. And so you guys are going to have us, it's gonna be separate from AWIG, right? There's
Yeah.
then now gonna be a new meetup group, and I'm sure we'll have like cross communications,
Yeah,
right? But
called
it's gonna be
AWIG.
all new, and you're just launching.
Yes.
Yes.
New separate group.
Cool.
Congratulations.
Yay. Thank you for having me.
I hope that was helpful, guys.
Thanks.
No, I want to join. Like, it's so
Yeah,
fun. Yeah. Yeah.